prices not moving should be visualized as a spring which is storing more and more energy, and it will eventually recoil and return everything that you deserve to be returned. That's another caricature that salespeople don't necessarily need to be extroverts. Salespeople who are quiet and who listen, they can do a good job. Everybody needs to visually understand what is the meaning of these two things. One, that equity returns are non-linear. And the second thing is that equity returns are hence lumpy. Uh, you know, uh, if you become better in the bad times, you will become bigger in the good times. If you see asset management as a profession or a business, 90% rule of this business is investment management. So if you have investment management capability, then you can build up.
Hello, everyone. Welcome to another episode of Talks with Daulat, where we aim to deconstruct the seemingly complex world of finance for you and empower investors to take better and relevant investment decisions. My name is Varun Fatehpuria, and I am the founder and CEO of Daulat Wealth Management. Today, we have a very special guest on our show, someone who has achieved remarkable success by climbing the corporate ladder and is now the chief executive officer of a prominent mutual fund company in India. WhiteOak Asset Management Company. Please join me in welcoming Aashish Sommaiyaa into the show today. Ashish, it is a pleasure to have you on our show. Ashish
Yeah,
brings
thank
a
you.
wealth Ashish brings a wealth of experience to the table, having served as his managing director and the chief executive officer of Motilal Oswal Asset Management Company. During his tenure with Motilal Oswal, the assets under management grew from just under 1,300 crores to over 42,000 crores in a span of 8 years across different investment products like domestic mutual funds, offshore funds, portfolio management services, alternative investment funds, etc. Prior to his role at Motilal Oswal, Ashish spearheaded the sales and distribution efforts for ICICI Prudential AMC and effectively led the sales and distribution efforts in India and Middle East. With more than 20 years of experience across business management, sales and distribution, product development, Ashish effectively has seen the growth of India's nascent private sector asset management industry ever since he started his career in 1998. Ashish, it is an absolute pleasure to have you on our show, and we cannot wait to dive in to understand a bit more. How did you get started with the journey? So let's dive into the first question, Ashish. What really, I would say, inspired you to join this industry when it was not, I would say, so hot right back in 1998, 2000? And how has your journey really, I would say, transpired from ICICI to Motilal Oswal, where you ended up being the CEO? And what was the motivation to, jump the ship and join an upstart like White Oak?
So thank you very much, Varun, for inviting me. Uh, Generally speaking, when you speak to anybody about, either their professional journey or their personal journey, or, if you speak about any kind of, uh, you know, uh, journey in any sense, typically what you get across is like a perfect backstory, right? I mean,
Yeah.
that generally things appear to be very, very well planned, and they appear to be like a well thought out sequence of events. Frankly, nothing like that, honestly, if you ask me. In the late 90s, basically by qualification, I'm a chemical engineer, and I worked in a manufacturing concern for some time. And back then, I was dependent on my sister to fulfill my educational, requirements. And back then, also in our country, we used to pay engineers quite badly, and computer science was not what it is today, right? Uh, so while I was dependent on my sister, she kind of suggested that till the time I'm paying for you, why don't you do your post graduation as well?
Mhm.
So that's where I ended up studying finance. And everybody in my classmate who had kind of an engineering background or a master's in finance, most of those people wanted to become portfolio managers, or they wanted to join a blue chip consulting firm, or they wanted to be investment bankers, or corporate finance guys, etc. And what I realized, by the way, so I start, despite whatever educational background, I started my career in sales. I was selling mutual funds through B2B distribution
Okay.
channels. So everybody with my kind of background wanted to be a portfolio manager, and sales at that point in time was heavily influenced by Miss Dipti Naval's portrayal in this movie, about selling soap. I don't know
Hmm.
if you've seen that movie, right? So sales was perceived to be a job where you would be ringing doorbells and trying to sell soap and shampoo. But as you'll appreciate, financial services, more specifically investment management, the sales is not what it is often portrayed to be. It's very consultative and it needs fair technical understanding of what economists and portfolio managers are communicating versus what the end customer will eventually end up understanding or consuming. So I found that interesting, because it needs technical understanding, but it also needs the art of communication, which is absolutely simplistic, right? So that's how I started off. And I found, I mean, from campus, even I got some blue chip kind of jobs, with consulting firms or with, very heavily regarded finance companies. But I just felt that for a technically qualified person with reasonable communication skills, the least competition was actually in sales of financial services. So that is the only time I think I used Michael Porter's uh, concepts very, very effectively and figured out where I could differentiate or position myself and start with a place which had least possible competition in terms of technical understanding as well as, in 1998, nobody went around taking a laptop and computing rolling returns and standard deviation
Correct.
and
Yeah.
duration of bond portfolios. So a good place to start. And then I persisted, I continued in the same role. At an earlier point in time, I used to think I'm quite introverted. I'm a misfit for the role. But I think eventually that's another caricature that salespeople don't necessarily need to be extroverts. Salespeople who are quiet and who listen, they can do a good job. So I think the early part of my journey was a lot of busting of misconceptions and figuring out how I can make my mark. So yeah, I mean, God has been kind. It's been an interesting journey. Also, one of my early bosses told me that however good you may be, the best of guys need a tailwind. And the reality is that in 98, 99, when I was a management trainee, from there on, India's capital markets and more specifically asset management has seen so you've been part of an escalator which was anyway moving up.
Right.
So yeah, I mean, it's been a great and exciting journey from that point on.
Great. And what was really sort of like your motivation? You had sort of joined Motilal, eventually
Mhm.
ended up becoming a CEO, and was already running a well-established firm, so to speak, right? I think there was only up to go from there. What was the
Yeah.
motivation behind, jumping the ship and joining WhiteOak, since again, it was relatively new into this asset management
Mhm.
space, and something which is really different from, serving the HNIs
Yeah.
through a PMS offering.
Yeah. So, if you really ask me, I perceive myself as a, generally the world is broken into either perceivedly broken into professionals or entrepreneurs. Frankly speaking, I see myself more as a professional entrepreneur. I may not necessarily have the capital or the risk appetite to pump in a lot of capital, but as a professional, I definitely have the risk appetite to be able to set up businesses or set up professional firms, right? And in my entire journey, I have had three or four occasions or opportunities where I have been involved with firms in very, very formative stages. Of course, when I was in ICICI in the late 90s, there were other people like me, and we were very, very junior, more like management trainees. But just to give you a sense of scale, when I joined ICICI Mutual Fund as a trainee, the assets under management were about under 1,000 crores, right? When I was head of sales of ICICI Mutual Fund, it was just touching 100,000 crores. And today, it's one of the largest asset management companies. Of course, I quit 10 years back, but the scale today. So then, for example, in 2007, actually, I had quit ICICI. I was a project manager with a French company called AXA when they were setting up their businesses in India. When I joined Motilal Oswal, like you said, my job was to, help them to launch active mutual funds. We also relaunched and repositioned passive mutual funds. We also scaled discretionary portfolios and the alternate investment funds. We launched funds in Mauritius and tried to get global money into India. So why I'm giving you this example is because I do believe that I have this penchant for trying to, I prefer to take on challenges, or I prefer to build new businesses or build new product lines. The other important thing is that, when I came across Prashant Khemka and the team out here at WhiteOak, I felt that there is a very solid institutional setup in terms of investment management acumen. Because prior to founding WhiteOak, Prashant was CIO at Goldman Sachs Asset Management. He had a long tenure of managing global money, which was invested into India. But this time around, when he set up WhiteOak Capital, unlike his previous stint, in this stint, he was very clear that he wanted to set up domestic asset management, managing money for onshore investors. So when I met him and I met the team here, I did get a sense that there could be a role for me to play in helping, because if you see asset management as a profession or a business, 90% rule of this business is investment management. So if you have investment management capability, then you can build around it. And however good you may be at organizational setups or strategy or distribution or product, if you do not have investment management, everything comes to a naught. So when I interacted with Prashant and the team here, I felt that there is a very strong institutional process, and the investment management capability is right up there, and there is something of relevance for clients which can be built.
Great, Ashish. I think one of the biggest benefits, or I think from our vantage that we can see in your career, is that obviously you have seen multiple market cycles, right? Whether as an advisor or as an asset manager, I think that is something that really comes in handy when you are ultimately dealing with retail investors' money, right? How do you need to be able to see the market cycles to be able to, impart that confidence into investors? And what we've been seeing in India at this point in time, yes, markets are at an all-time high right now, but this is broadly where it has been gyrating over the last 18 months or so. So, what advice would you have to investors at this point in time? Because as wealth managers, we often have investors who come to us, and their often fallback is we would have just invested in fixed income and at least got a 7 to 8% return, right? That view of viewing equity as an asset class of wealth generation starts to fall off the moment they start seeing stagnating returns, right? So what advice, or how do you deal with such periods, and your advice to investors be at this point in time to just stay invested in the markets?
Yeah, I think I'll answer this on two fronts. One, as you'll appreciate, that investing is a lot about behavior, and behavior is a lot about how you envision, how you visualize a situation. Right. Now, what happens is that whenever the market falls or whenever the market is flatlining, most people feel exactly the way you said that, if I put in a fixed deposit in a matter of 2 years, at least on a gross basis, the 100 would have become 113, 114. And now I'm in equity. And, after 2 years, my 100 is more like 90 or 95. So then, I am 25% behind or 20% behind where I could have potentially been. Now, this is the holy grail. This is the pitfall, right? But the point is, if you visualize that it's 95 instead of 114, that is one way to look at it, and that can really psych you out of investing in equity. But I always visualize these things, more in terms of physical or science kind of related objects. See, if you look at a spring, for instance, right? Let's say there is a spring which is 10 centimeters in size. If you compress that spring by, let's say, 50%, obviously it will become 5 centimeters in size. So most people who are observing this arithmetically might say that, oh my God, it's 50% down. But the point is that a spring becomes a lot more valuable when it is actually compressed, right? Because it starts storing energy. And a spring which is 50% compressed, if you release it, it will not recoil 50%, it will recoil the entire 100%. So if you take the last 18 months, what has happened is that in 18 months, Nifty is at the same level, but the reality is that in those 18 months, the EPS of Nifty companies has gone up by about 25 to 30%. And for good companies, the cash flows might have even kept pace or gone up much more, right? So the point is that stock markets are such that to the extent that you're dealing in a portfolio of going concerns, prices not moving should be visualized as a spring which is storing more and more energy, and it will eventually recoil and return everything that you deserve to be returned, right? So I think one is it's a play of how you visualize situations, and it needs good understanding of the market phenomena for you to visualize it in the right way. That's one. Second point is that if you really see the last 18 months, I mean, look, we are lucky that we did not see a 20-30% correction given all the macro headwinds, right? I mean, emerging market led selling, China and US led tech collapse, the war and commodities and interest rates. I mean, so many things happened. We deserve to be 20-30% lower, but I think the reality is that domestic investors' appetite for investing in equity, and on the other hand, we were able to manage our fundamentals. And probably RBI did a great job, and even the fiscal policy was in the right stance. So I think we got away with very less damage. And frankly, if 100 rupees becomes, I'll give you an example. Let's say there is a packet of biscuits. It's available for 10 rupees, right? 18 months back. Today also it is available for 10 rupees. But the point is that 18 months back it had five biscuits. Today it has six or seven.
Yeah.
So how you visualize these things, and how you visualize these things and how you react, I think that is what determines the success of any investor. And again, I'm repeating, last 18 months we've got off lightly. It could have got worse. Similar things playing out maybe 10 years back, India would have been 25-30% down.
Yeah.
So we should read into these resilience and get confidence from that actually.
Great. So, Ashi, that provides us a very good segue into another interesting concept of, yes, definitely everyone is out there looking for returns, and in the bull market, sabko return chahiye. I think at that point in time, if they're not invested into equities, they think they're sort of like, missed the bus. But I think again, at this point in time, when markets stay flat or is just sort of moving sideways, people also realize the importance of having a very good asset allocation strategy, right? I think that is something that is definitely not very well appreciated by Indian investors when we go out, speak to them, try to make them understand of having a proper asset allocation strategy rather than randomly investing into, the best performing or the best return generating instruments, right? So why do you think asset allocation as a strategy is something that is really important for investors today, having a mix of multiple asset classes, not just within equities, but also, let's say, debt, fixed income, international investing? How does that play into an overall investor's return over a longer period of time?
I think that it's very clear that none of the asset classes has a desirable outcome in a linear fashion, right? Say, for example, if you look at equities, one needs to understand, again, visually, you need to understand that returns in equity, if somebody says it is last 30 years Sensex is 12.5% compounded since India's liberalization, let us say, then the 12.5% compounded is not linear, right? It's obviously a combination of some 20%, 30% down and some 10% up and so many discrete calendar years or discrete financial years and the average of all of them, right? And then you will end up at that 12-13% CAGR. So I think this CAGR is a very misunderstood concept. Everybody needs to visually understand what is the meaning of these two things. One, that equity returns are non-linear. And the second thing is that equity returns are hence lumpy, right? So if you look at the last 5 years, look at it this way, Varun. In last 5 years, everybody has a handsome double-digit return, right? We are in June 2023 and we are sitting on 18,500 on the Nifty. You might recall that same period 5 years back, Nifty was 10,000. So in 5 years, if it is more than 80% up, then we must have got some 14% compounded kind of number. But let's look at it this way, that from June 2018 till April 2020, you made a loss. The market yo-yoed up and down, but eventually by April 2020, you must have been 30% down. Then from April 2020 till October 2021, you had this rip-roaring rally and big appreciation. And we just discussed that from October 21 till now, it's practically nothing. So in this 5 years, Varun, if you look closely, in this 5 years, people made return only in between a window of 18 months. And what is the staggering fact? You take any 5-year rolling period, for a year or 2 years, market goes nowhere. For a year or 2 years, it's actually declining. It's always this period of couple of years in between where you get disproportionate or above average return. And that's the whole point. That's why I said that equity returns are non-linear and they're lumpy. And when the return is being generated or when the index reflects the earnings, that is the period when you really need to be there for you to enjoy that benefit. So returns are non-linear. Now, the point in time, if you are fully invested in equity, when market is doing nothing, then you will definitely feel stressed about it. You will feel I should have been in a fixed deposit. On the other hand, that period of couple of years when the market is really giving a big rally, if you're not in equity and you are sitting somewhere in some other asset class, then you will again feel stressed. The problem is that which year or 2 years in any 5 year time window will really reward you seems to be kind of difficult to forecast. When I speak, people might think this seems easy, but the
Yeah.
reality is it's not. Correct. So ultimately, the holy grail of investing is that you need that 9-10% coming to you year on year. But equity is incapable of giving it to linearly, and fixed income is incapable of giving you more than 6-7%. So what do? You need a healthy mix. And every once in a while, there is a global crisis or big depreciation in the dollar, and suddenly gold starts going up, right? So gold is also a hedge to equity. So the point is that you need asset allocation because none of the asset classes can give you linear return. None of the asset classes can give you the desirable rate of return. So you need a healthy mix to tide over all these kinds of circumstances. And finally, I will say, just like I've been comparing in other examples also, finally, I will say asset allocation is like chemistry, right? When you mix each of these asset classes, they should be uncorrelated or they should have low correlation. And when you mix two or three asset classes, you should learn to see your return at a portfolio level. If I mix Indian equity, global equity, fixed income, and gold and create a mix for you, and then depending on macro circumstances, I keep rebalancing the mix to optimize your portfolio, it is going to give you one end product which should reduce your volatility compared to any asset class and which should optimize your return compared to any one asset class, right? So I think asset allocation is very scientific. It is something which is required to tide over the pitfalls of our behavioral biases. And it is most important because it will keep you in the market. Look, if you're overexposed, you will get thrown out. If you're underexposed, you will just be watching from the sidelines. So how do you participate consistently in a healthy manner? Basically, you never get exaggerated, you never get exposed to extremes, right? You are always in a right balance. I think people make big mistakes when they react emotionally to their investments. But people are likely to react emotionally to their investments only when they are exposed to extremes. So asset allocation is a great way to ensure that you are never exposed to the extreme vagaries of any market cycle.
So Ashish, I think that's a very good point that you made that, people just need to stay invested and not react emotionally. Yet again, we see a lot of investors basing their decision based on, let's say, what's happening in the US, वहाँ recession आ रहा है, वहाँ पर inflation इतना बढ़ गया है, or let's say the Russia-Ukraine war, how that is sort of like, impacting the economy. Yes, all these events definitely tend to play a role in what happens domestically, but I think, again, as investors, we need to be humble enough to decide that probably we'll not be able to make such calls and perfectly time the market. There is so much that we are exposed to at this point in time from a news perspective that people try and base their decisions on what they're reading pretty much every day. It's an information, I would say, fire hose, basically, right? So, how do you sort of like, draw out that noise? How do you tell investors that, yes, definitely pay attention to what's happening in the world, but do not try and make investment decisions where you think will not be able to add value? Well, that's something that again we try and explain to investors, but then that sort of like becomes difficult in this I would say hot media cycle.
There is one unfortunate thing about what you just referred to, which is information fire hose, or then you use the great phrase, which is this hot media cycle, more 24 by 7 news. There is one big problem with being right on top of all information. It gives you the illusion of being knowledgeable, right? So I'll give you an example. And this is funny actually. If you see in October 2021, we hit 18,500. And then everybody felt, market is overvalued. So then if you switch on the television, someone will tell you, yeah, but India ka Amrit Kal aa raha hai. It deserves to be 18,500 and we will make new high. But look what happened. By May 2022, we were 15,200 on the Nifty. So then you are left wondering, I mean, what happened? They say, yeah, but look, oil is $125 and there is a war in
Yeah.
Europe. Right? So you consume that information and you feel, yeah, okay, I got an explanation. Yeah, I mean, fine. I'm in control. But when you get the explanation for 15,200 in November 2022, you find yourself at 18,800. And then again, there are explanations that, okay, look, the world has got used to the war, oil prices are down, it's okay, blah, blah, blah. And you believe in it. By March 2023, you are at 16,600. And again, there are explanations on US, higher for longer. And so, what is the problem? The problem is, look, nobody told you that there will be a war in advance. Nobody told you in advance that China will not have a great reopening and oil will go to 70. Right? Nobody tells you all this in advance. But the point is that the moment it happens, there are such intelligent explanations that it gives you an illusion of having understood everything. Yeah, okay, I've understood, and next time I think we will. It's all explanation in hindsight. Prashant is a very practical person, our founder, very long experience. He always tells me that, look, first the prices come and then the backstory is coming in. Right? There are always explanations in
Yeah.
hindsight, but did anybody tell you in advance that load up your portfolio with PSU because there'll be a war and oil and energy will go up? Answer is no. Charlie Munger once said that if you tell me where I'm going to die, I will never go there. So that's a highly sarcastic statement to say that you can never be in the right place at the right time.
Right.
The only thing you can do is to have a judicious asset allocation because, have a broad portfolio which invests in best companies across all sectors. Don't try to figure which sector will work because which sector will work depends on rupee, depends on oil price, depends on the war, depends on government policy, US FDA actions, so many things. So you will never be able to forecast these macros. It's a completely, it's a coin toss. You will never be able to forecast macros. The only thing you can do is to have a broad portfolio across all sectors and an asset allocation which takes care of all eventualities and never exposes you to extremes. I think that is the key point. You can always watch the news and you can always listen to, Ashish and Varun so that you get some clarity and some explanation. But however great insights you and me might provide, I don't think we can comfortably predict which geography of the world or which sector is going to be the star for the next couple of years. Not possible.
Right. And I think that's very humble of you, of Ashish, to admit that. Right? I think you'll again find a lot of experts today who will proclaim to have seen the world through a certain lens and forecasted events ahead of time. But I think a lot of the investors again fall into this trap. So, but let's say someone who is just getting started with investing. Again, there is so much of knowledge, active or passive, large, mid, small, international, value, growth, and people can just get lost into so much literature that again we see people are afraid of taking that first step because they are afraid that probably the decisions are not very optimized to, let's say, what my goal is. So where should just an investor just get started with investing? Like simple, if someone wants to test the markets, where should it get started?
Yeah, I think, it's like this. If you are entering into something, like investing and stock markets, equities, mutual fund NAVs, they are like a ongoing journey. It started somewhere and it's never going to end, right? You cannot trace it. You cannot trace the stock market and the economy back to its evolution, and you cannot forecast the end of it. It's just an ongoing journey. It's like a running train, a perpetual train, perpetual motion machine, or whatever you call it. Now, in this, what happens is it's everybody has this penchant of entering this perpetual motion machine and trying to run faster than the natural pace of that machine. I think that if you just enter it, right, and if you are above average or even if you get average. So one is that, if you have no clue where to start, like I always tell people, if you don't know what to buy, just buy the market. Because at a very elementary level, it is just important to participate. So it's like this. If I was somebody who had no clue about stock markets and about investing, and I was just somehow convinced by someone that, look, if you want to grow your wealth, then you should enter into the stock market. And let us say I had no idea the stock market was this black box, but I just know that, okay, somebody has explained to me that yes, it grows at 12% year on year. So I'll just buy Nifty 500 because I don't know where to start. So I say, okay, let me buy BSE 500 or Nifty 500 because that's 96% of the market. So I bought the market. So now I have a foot in the door. I'm assured at least that I will be performing as per the average, right? And then yes, of course, look, if you go to a classroom or if you go to a hall or an auditorium and ask some 100 people that how many of you think you're above average at driving or how many of you think you're above average at XYZ talent, I think 80 or 80% of the people will raise their hand and say that I'm above average, correct? So people are not happy with averages. So till the time people are not happy with averages, they will want active management and they will want to outperform the market and they will want to do better. So first get your foot into the door. First start participating in the market. and then figure your own way of how you think you can get couple of percentage points more, which is the best team, which is the best sector, which is the best fund manager or the fund house, or which is small cap is good for me or mid cap will outperform. All that can happen later. The first and most important is to participate. Get your foot in the door, participate, and then, figure your way out.
Great. Thank you so much for all of those valuable insights, Ashish. And before we end, just on a very personal note, obviously you've had a very illustrious, a glorious 20, 24 years career in this industry. And obviously it has never been a straight line, as you admitted, right? So if you had to go back in time in the early 2000s and tell something to a young Ashish, what would that be?
See, I think I would have definitely, see, unfortunately or fortunately, whichever way you look at it, a lot of learning. Like one of my bosses used to say, I put in Hindi, खुद के मरे बिना स्वर्ग नहीं मिलता. Maybe you heard this, right? So, uh, I don't know in hindsight what I would have said, but yeah, if only I had an idea that, you should keep expectations realistic. Like whatever I said, about equity returns are non-linear, they are lumpy. And the best, you learn the best when things are really bad. Like if you ask me, my understanding of markets, my understanding of the mathematics which drives the markets, my understanding of asset classes, of people, has always come in phases like March 2020 or, September 2008. And there's another one of my bosses actually said that if you want to become, if you become better in the bad times, you will become bigger in the good times, right? So our quantum learning always comes when markets are going through a seriously bad phase because that exposes you to the extreme, right? I myself invest only in equity. Every once in a while, my own 100 is down to 60, 70, or 80, unfortunately, right? But those are the times I learn the most about the markets, about people, about myself, about asset classes. When Nifty is 18,500, everybody's a fund manager and everybody's an economist, right? But if it were to fall 30% tomorrow, that will separate the boys from the men and that will really bring out character. So I think if I had known that you should enjoy the tough time and you should be thankful to God in the good time, then maybe I would have done slightly better, I guess.
Great. This was a very insightful session, Ashish. Thank you so much for spending your time with us. And I hope our viewers and listeners take away something from Ashish' glorious career over the last 20, 24 years in this asset management industry. As he correctly again always pointed out, I think it's important to stay humble and just stay invested in the markets. And I think the rest of the things will take care of itself. So that's it for today with us. And we look forward to having you in our next show.